Good evening, everyone, and thank you so much for joining me. Tonight, we are doing Chapter 6. Let's go through it. We're talking about inventory, and it's really, I think there's an argument for doing inventory before we do Chapter 5, which is merchandising operations, but they do merchandising operations first. And I want you to recall from Chapter 5 that we use the perpetual inventory system, and that means we recorded the following. Whoops. Just one second. Okay, that means we recorded the following. So we had inventory, also called merchandise inventory. You know, last week I mentioned that I don't call it merchandise inventory, I just call it inventory. That's because there are companies that have supplies inventory, raw materials inventory, merchandise inventory, so they denote it at merchandise inventory. I'm just going to call it inventory. We know that inventory is an item which is purchased and then sold again. Not for use within the company. So we know when we were recording inventory using the perpetual inventory system in Chapter 5, when we bought inventory, we added it in. When we sold it, we took it out. When we returned it to the supplier, we took it out. And when a customer returned, and it was still usable, we put it back in, and we ended up with an ending inventory value that's right here. So this was our ending inventory. So that's what we did last week. And the question becomes, looking at this value, wait, let me change my color for a second. Looking at this value right here, it's not a real value, but looking at what would have been the value here, the question is, can we, at period end, record this on the financial statements? How do you feel about that? Yes or no? Can we put this on the published financial statements? No. Mark, why not? Lauren, I want to know why. But we have a value here. We actually have a value. This going in and out has a value. You've got to assume that when we're using the perpetual, because it may not be accurate in real life. Can you clarify that? Weighted cost, damaged goods or item go missing. Okay, yes. So Mark, I'm just going to pause for a second. Thank you, Lauren. That's exactly why we can't publish this. But Mark, I want to address something. When we were using Chapter 5, when we were doing all these entries, the assumption is that the company has chosen a method. The company is using already either specific identification, FIFO, or weighted average. We don't wait till the end of the year to actually value this inventory using one of these methods. And that's why I find having Chapter 6 after Chapter 5 causes some confusion, because the assumption is that we wait until the end of the year and then we use one of these methods to value our inventory, and that's not what happens. We choose a method, and throughout the whole year we use that method to value our ins and outs of inventory. So we've chosen a method. Let's assume this company is using FIFO. So they've got a method, they've used FIFO all the way through as they are buying and selling their inventory, and then they have this value at the end of the year, and the question becomes, can we actually publish this on our financial statements? And the answer is no. And there's a number of reasons. So Lauren has raised some good issues. There may be damaged goods or items which go missing. So this number needs to be verified. Okay, there has to be a verification process to confirm that the inventory records are correct. And this is because, as Lauren pointed out, there may be damaged goods or items which go missing, which is called shrinkage. So shrinkage is really theft by either customers or, believe it or not, employees. There could also, by the way, be human error. So a cashier, last week this happened to me, a cashier scanned one of my products and scanned the other one, and they both looked the same, but they weren't, right? So an example would be raspberry jam and strawberry jam. the example that I have from last week is actually I bought something that was orange flavored and the other one was lemon flavored, and she scanned one of them and just did multiplied by 2. So now both the orange flavoring and the lemon flavoring are both wrong because orange 2 were removed and lemon 0 was removed. So this causes inventory to be wrong. So how can we verify the number, the system number, is correct for ending inventory? And count. Yes, that's exactly how we do it. So what we have to do is both IFRS and ASPE require an inventory count at least once a year, minimum, a physical count minimum once a year. And I have to tell you, quite interestingly, I was working on my daughter's house and we went into the home hardware on the 2nd day of January. And what were they doing? They were counting every single item in the store. They didn't shut down. They just back out whatever they sell for the day. But that's exactly what they were doing. And I'm sure many of you guys have been involved in inventory counts. So say we do a count. Can we publish that number? So count, we now know, oops, I want to change the color. We now know we have to do a count at least minimum once a year. So we count, and we get a verified number. Can we publish that number? So let's assume we counted and the number was the same. Can we publish the number now? What are your thoughts? Yes or no? Let's have a vote. We've counted it and it verifies. Yes. And the answer is no. The answer is no. Because this is inventory on hand. And that's problematic. Because we now know, if you look at most of the things that you have around you, and certainly most of your pieces of clothing, I bet you they do not say made in Canada. I bet you they say made in Taiwan or Bangladesh or wherever it is. So goods in transport, or goods in transit. So the biggest issue is after, so we've got a number on our inventory system using the perpetual inventory. We then count it and get some kind of verification with regards to the number of units. Then what do we have to do? We have to check, so after the count, we have to check for ownership. Now, there are two issues with regards to ownership. One is inventory in transit. Right? Who owns the inventory? And then the next one is consignment. Absolutely. So, two issues here. Inventory in transit may belong to the company. That depends on its shipping terms. Remember the FOB shipping point or FOB destination? And that depends on whether we are the shipper or the receiver. I mean, it might be in some cases that FOB shipping point, because we are the receiver, belongs to us. Or FOB destination, because we're the shipper, belongs to us. So those items, even though they are not included, don't forget, they would be excluded from the account because they weren't there when we counted the inventory. So they wouldn't show up in the count. But it may still belong to us. And in that case, we have to adjust the count to put it back or to add it. Add it or put it back. Right? Now, consignment goods, these could belong to the company. It depends if we're the consignee or the consignor. The consignor owns, but no possession. And the consignee has it, but no ownership. right? The consignee has the inventory. A good example would be the magazines that you see in all the grocery stores. The grocery stores actually do not own those magazines. They do not pay for them. Instead, the publishers give them all the magazines. They literally just give it to them. And they know how many magazines have been given to each of the grocery stores and which magazines they've given them. And then when the magazine, date is gone, it's now an old magazine, the publishers require the companies to send back the old or the unsold magazines, and they will pay them for the difference. So let's say they ship out 100 magazines to the grocery store, and the grocery store at the end of the time send back 35. So this is shipped, and this is sent back. So what happens is they'll pay them for the difference. But during that time period, the grocery stores are consignees. They have the magazines, but they don't own them. The publisher is the consignor. They don't have the magazines, but they totally own them. So we have to take both of these things into account to adjust the inventory count for ownership issues. All right. We do that before the final adjusted count is used in order to publish on our financial statements. And actually, we do one thing even after that, but we'll talk about that in a minute. When would grocery stores record revenue? When they send back the returns or pay? When you say when they pay, what do you mean by when they pay? So what happens is they can claim revenue as soon as they sell the magazine, because as soon as they sell the magazine, they have done their job. Now, what's going to happen is when they sell the magazine, so let's say they sell one magazine and their fee, let's just assume their fee is $4 for selling a magazine. They get $4. So as soon as the magazine is sold, what's going to happen is there's going to be a credit to revenue, because they've earned it as soon as that happens. And there's going to be a debit to accounts receivable, because they have a right to receive that. When they get these magazines, they actually don't put them as an asset. So when they receive the magazine, it actually goes into a special inventory count called a consignment inventory. And that never shows up on the financial statements because they don't own it. So it can't be an asset because it's not owned. So they basically record a consignment inventory invisible thing. I can't call it an asset. They don't own it, so it's not an asset. And when it's sold, they're going to claim the $4 in revenue and accounts receivable, and consignment inventory goes down. So they would record the sale as each one is sold. If they've got a computerized system, that's probably what's happening. Yes, because they have a legal right to do that. And keep in mind, when they send back, I'm not sure what rules apply, because I haven't worked with a client that's a grocery store, but when they send back the unsold ones, even if some of them are stolen, I believe the company still pays them for whatever is no longer there, because there's no way of tracking whether it's been, well, they could track. I wonder how they do that in a grocery store. If anybody works in a grocery store, you'll have to tell me. But yes, okay, so now we know this. So let's just see about this adjustment that needs to be done. Remember, we're assuming that we've already finished the count. The count is done, and we've verified it against the accounting records. We're now doing the ownership check. So let's work on Q6-1 to do the ownership check. All right, so in this question, it says it's December 31st, 2016 after the inventory count. Green Ink has counted 2,458 units of product XV4. However, the count coordinator wants to know what, if any, adjustments must be made due to the following items. Unless otherwise stated, the items are not included in the inventory count at December 31st. So I'm using unadjusted. Now, many of the questions in the textbook actually use dollar value, but that's not how we used to do it when we actually were doing the count. We used to use units. So that's the number of units we have. So now we have to go through each of these items and determine, should we add it, or should we subtract it, or should we do nothing? Okay, so start with number 1. Green ink, and don't forget, we are green ink. So that's our role. We're looking at green ink's inventory. Green Ink ordered 140 units of XD4 from Dillon Supplies on December 28th, FOB destination. They arrive on January 3rd. Adjust? No adjustment? Exactly. Now, remember in an exam, if I ask you this question, you're going to have to say something like, just to give you an example, so first of all, what's our role? We are the buyer. It's shipped FOB destination, which indicates that the seller owns, so no adjustment necessary. So remember, you've got to tell me your role. You've got to tell me the shipping terms, which is what indicates ownership, and then you're going to give me the answer. So make sure you're supporting your position with reasoning if I ask for that. Just a heads up. All right, so we're not going to do any adjustment because the seller owns and we are the buyer, so no adjustment necessary. Okay, number 2. Green Ink has shipped 250 units of XD4 to a retailer on December 29th, FOB shipping point. They arrived on January 6th. Adjust, no adjustment, add, subtract, what do you want to do? Adjust. So we're going to subtract 250. Everybody agree? Nothing? Okay, so let's just go over. We are the seller. It's FOB shipping point. The inventory is no longer ours. I agree with that. The inventory is no longer ours. I'm asking why there is an adjustment. Because I've got some people saying no adjustment. FOB shipping point. So that indicates ownership transfers to the buyer right away, and we are the shipper, so they're the receiver. I agree. I agree. It's no longer ours, and it wasn't included, so there should be no adjustment. So does everybody understand that? Look at the top again. It says, unless otherwise stated, the items were not included, right? So this has already been excluded from the inventory count because it was gone when the count was done. So we don't have to subtract it unless it told us that the inventory was still included in that 2,458. So be careful about that. Look at the top blurb. Make sure it's clear, because otherwise you're going to be stuck when you do a homework question on this. Remember, if anybody didn't understand the explanation I gave, just please ask me and I'll explain it again. But no adjustment, because we didn't include it in the count. All right. Number 3. Green Ink ordered 250 units of XD4 from a new supplier, Hillsdale, December 29th, FOB shipping point. They arrived on January 2nd. Plus $250. Oh, sorry, 250 units. Adjust. Everybody agree that it's plus? FOB shipping point. Exactly. This is plus 250 units. So let's just go over why it is. So who are we? We are the buyer. It's shipped FOB shipping point, which means that the buyer owns it in transit. We've got to add it. Excellent. Number 4. They also shipped 400 units, FOB destination. They arrived on January 12th. Adjust or no adjustment? Okay, we've got no, adjust, plus 400, and adjust. So let's go through it. So who are we? We shipped it, so we are the shipper. We shipped it to a retailer. It's FOB destination. It is definitely ours. Do we have to adjust? Yes, because these items were excluded from the inventory count. So since they were excluded from the inventory count, that tells us we have to add them back in. We have to put in the 400 units. So again, walk through it and say to yourself, shipper or receiver, FOB destination, FOB shipping point. That will tell you ownership, and then be careful about the information at the top. Has it been included or excluded already? Last one, number 5. Green Inc. has provided 500 units of XD4 to a major merchandiser on consignment on December 20th. Green hopes that this will cause the merchandiser to carry their products in the future. These items were not included in the inventory count. Exactly. What is our role? We are the consignor, and consignors own, but they do not possess. So in this case, we got to add in the 500 units. And that means that the ending inventory is, somebody want to tell me? $3,608 units is the adjusted. Now keep in mind that in the questions you see in the textbook, you will see them use dollar values, but units is normal in businesses. Now keep in mind that at this point, we would be using one of our methods to value these 3,608 units. It's not as if we're not using a method. We have already decided that we are using either FIFO, specific identifications, or weighted average. This is a done deal. Companies determine their method and they move forward with it. So at this point, this would already be easy to value, but I'm going to show you how companies value it. All right? We've got 3 methods, both IFRS and ASPE. Both IFRS and ASPE allow 3 costing methods. We've got specific identification. We have first in, first out. And then we have what's called average. Companies have to choose one method. Once a method has been chosen, companies must apply the method consistently from period to period. Just be clear on that. It's got to be consistent. Companies are only permitted to change their method to a different method if the new method will provide more relevant information for external users. So that really means that the information will be better for decision making. Now, who decides that? The company does. But you have to put quite an extensive reasoning in the notes to the financial statements. So it's not like you can just change. You can't. Once you've decided in your company the method you're going to use, you move forward with that method. If they change due to a reason other than more relevant information, they're not actually permitted to change. All right? So I'm going to demonstrate all 3 methods using Q6-2 so you can clearly see the differences between the 3 methods and the effect that each method has on the financial statements. But keep in mind that companies would choose a method at the inception of the company, and they're moving forward moving forward with it. And as they're buying and selling inventory, whatever method they chose, they're actually using this to do the entries. And let's just go back. These entries right here, all of these entries that they did right here, all of them was already using, if this company used FIFO, they're already using FIFO for all these entries. All right? So I just want to be really clear with that because I think it's confusing the way we do it, and I don't think there's a better way of doing it. All right, so let's start with specific identification. And not for any reason, I'm just starting with it. I don't know why it's doing that. All right. This is recommended by IFRS if inventory is uniquely identifiable, and that usually means something like it has a serial number. It's also necessary that cost of tracking individual inventory items is not cost prohibitive. So let's say we can use specific identification for memory chips because memory chips all have a serial number, but the dollar value of memory chips is really, really small. And the fact is, we produce millions of memory chips every single year. Any company that's that's manufacturing or selling memory chips is probably manufacturing or selling millions of them. And so using specific identification, even though they can, because each memory chip is uniquely identifiable, they never would because it is cost prohibitive. So generally, the inventory items that use specific identification are high dollar value, and low volume. That is not necessarily true. That's just what most companies do, because if it's cost prohibitive to use specific identification, you don't have to. All right? So let's calculate both the cost of goods sold and ending inventory for this. Now, I'm going to give you a heads up. I'm not going to use the method used in the chapter. I find that method on exams is really, really long and complicated. If you want to use the chart, which has 9 columns, feel free. You do not have to use this method that I'm going to show you. I'm just showing you so that you can use it as an alternative. All right? And while I'm showing you this, it will be very clear exactly how it's connected to the chart. All right, I'm going to go to a new page so that I have lots of room. So I've got here, I've got the date, and I've got what was bought. And again, I'm not using the method in the chart. I've got what was sold, and then I've got a balance. I've got the cost, and then I've got the value, okay, of ending inventory. Ending inventory, and then I've got the cost of goods sold value. All right, so this is what I'm going to do for specific identification. Now, you can see in this question exactly what's going on. Wait, where's my question? Wait 1 second. All right, so we've got Gray Limited, a wholesale business, has the following inventory transactions for the past month. So August 1st, they have opening inventory, then 7th, 13th, 20th, and 25th. And we've got to calculate the cost of goods sold in the ending inventory using perpetual inventory system. And we're going to track the impact on the financial position and income statement for each of the methods. All right? So now that we know what we're doing, let's look at it. On August 1st, we had opening inventory. So we didn't buy it, but it was opening inventory, 38. Okay? When we bought it at a cost of $13. All right. That's all I'm going to do right now. So that was on August 1st. Now, what happened right after that? On August 7th, we purchased 150 units. So August 7th, we purchased 150 units. And the 150 units was purchased at $14.25. All right. So now, on August 13th, we sold 130 units for $28. The selling price never matters when we're valuing inventory, because the only thing we care about with inventory is cost. We don't care about the selling price. So whenever you see one of these charts with the selling price, totally ignore it. It's one of the most common errors that students make. All right, so we've got the 150. So August 13th, we sold. So we know on the 13th we sold. How many did we sell? We sold 130 units. And the information under 1 says the items sold on August 13th were all from the August 7th purchase. So we sold a total of 130 units. I'm going to put that in brackets. That's what we sold from there. Okay. Perfect. We're going to keep going. I'm not going to calculate anything yet because I don't know where the other units that were sold went to. So now I'm going to go forward. I've got August 20th. On the 20th, they purchased 125 units, and they purchased them for $15.50. Perfect. So now, next, on August 25th, they sold 130 units for $30 each. Again, we don't care about the $30. We only care about costs. And then in the additional information, I hope everybody's following along with where I am, items sold on August 25th were 20 units from August 1st. And 10 units from August 7th. The remainder of the units were from August 25th. So that's 30 units. We sold a total of 130 units, so 100 units were sold from August 25th. So if we now subtract the 38 and the 20, we know that the balance in inventory from this batch of inventory is 18. From this batch of inventory from August 1st, which are all specifically identified, we can actually see them with regards to a serial number or some unique identifier, we have 18 left. The 18 left is at $13. So 18 times $13 is equal to $234. But I need the cost of goods sold also. So I'm just going to change my color for a second so that you can see this. If I take the 20 units and multiply them times the $13, it will tell me that the cost of goods sold for these units that I sold out of this batch is $260. Does everybody see how I'm doing that? Thumbs up? Are we clear? Okay, good. So now, again, the 150 minus the 130 and minus the 10, right? Because we want to take away everything that we sold. That means that there are only 10 units left. These 10 units times the 1425 are $142.50. That's in ending inventory. But we also have, change my color again, we also have this 140 units times the 1425 to give us the cost of goods sold. And the cost of goods sold is $1,995. All right, let's go to the last one. 125 units minus the 100 units tells me that there is 25 units left in ending inventory. Those 25 units are at $1,550, which is equal to $387.50. But I also sold 100 units, which cost $1,550, so that is equal to $1,550. I can now add this up, and it will tell me that the cost of goods sold is $3,805. If I add up the other numbers, it will tell me that ending inventory is sitting at $764. It also, this chart also tells me exactly how many units are left moving forward. So if I want for next year, right, or next period, I will know that there are 18 units at $13. So when I start my chart next period, I'm going to start August 1st. And with the August 1st, I'll put 18 here, right? And I will put 10 here, and I will put 25 here, and everything else will be blank, except for the 13, the 14, 25, and the, right, I'll need this information too. And then I can start again, and then if I buy more, I'm just going to add it down underneath, and the sold will be taken away. So is everybody clear on how I use this chart? And as I said, it is different than what's in the chapters. Well, yeah, that's just, the big spreadsheets are really confusing, and it takes a lot, right? Like and this is calculating the same thing, just faster. So now, do you have to use this method? Absolutely not. You want to use the 9-column thing, go for it. This is not a requirement. I'm just showing you an alternative. All right, so remember I said I wanted to track, and I do want to track. I want to track what's going on in inventory when we're comparing the methods, right? So let's do a tracking chart. Because it's really important to understand the impact on the financial statements of these 3 different methods. What's ending inventory? What are the words above value? Yes, ending inventory and cost of goods sold. All right, and I'm going to flip back to that in a second. So I want to know what's happening here. So here I've got specific identification, I've got FIFO, and I've got average. I'm going to track what's going on. Now, what do I want to track? I want to track the value of ending inventory, and I want to track the value of the cost of goods sold, and I want a total to see are they all matching. Okay, so let's just flip back for one moment. So we've got 764, 3,805. So we have 764, 3,008 whoops, there we go. And that is equal to 4,569. So the 4,569 is called available for sale. So let's just clarify this. It's called available for sale. That's because it was all the inventory throughout the period that was available to be sold. So that's the total amount of inventory that we had, not what we have at the end of the period. At the end of the period, we only have ending inventory, but that's the total amount of inventory that was available to be sold. All right. Any questions about this method, specific identification, or can we move on? We good to move on? Okay, I see some thumbs up. Okay, good. All right, so let's move on then to FIFO. Now, FIFO says first in, first out. So physically, the items that come in first in the back door are going to be the ones we're going to assume that they are the ones that are first going out the front door. Now, is that really true? Sometimes we can control inventory. So for instance, if you go to the back of the grocery store, you'll see the area where they sell milk. Now, all the milk is very controlled. They only put, 2 containers of milk in there, and you don't get fresh milk unless it's emptied. But in other places in a grocery store, they might assume that you're going to choose the jam from the front of the shelf, but I don't do that, because when they restock in a grocery store, they take everything off the shelf, they put new stuff in the back, and then they put the old stuff in front of it. So I always grab from the back. But the assumption with FIFO is that nobody's going to do what I do in a grocery store. Everybody's going to take the items from the front, and therefore they will be able to control the flow of goods. The first items and the oldest items are going to be the ones first in the back door, which are now the oldest, are going to be the first out the front door. So this is an assumption we are making when we use FIFO. We actually can't control it all the time, but it is an assumption we are making. All right, so what do we need here? Well, we need the date, the description of what's going on, the units, the cost per unit, and then the value. Okay, so remember on August 1st, there was opening, right? Not a purchase, there was opening, and it was 38 units, and they were at $13. And if I multiply this, it equals $494. Okay, so now on August 7th, there was a purchase for 150 units, and that was at $14.25, and that equals $2,137.50. Now, if there was another purchase, I would simply keep listing all the purchases until we do something different, such as sell it. So keep in mind, if there were more purchases, I would just list the purchases and continue to list purchases until there were no further purchases. But as soon as it flips to sale, I got to do something special. I got to do a balance. So I'm going to do a balance. There's nothing under the description, right? But I'm going to do a balance here. This is 188 units, right? I'm not going to put the value down here. I'm going to put the total of this. This is $2,631.50. All right, and don't forget, I did a balance because the next item is a sale, right? And so I'm going to do the sale in a different color so that it's clearly visible that we're using a different color. All right. So now I sold. Now, oh, I should have done the date here. I don't know why I didn't think to do the date here. That's rather silly of me. My apologies. So the date was, because I didn't list it down, of course, because I'm foolish. In 1 second when I was doing my math. The date is August 13th. Yes, August 13th. So my apologies. August 13th, I made a mess. Sold. And here I put the total number sold, 130 units. Now, don't forget, it's first in, first out. So of those 130 units, I'm first going to get rid of all the old 38, right? I'm going to get rid of 100% of the 38, and I'm going to transfer down the $13. This is going to be this. We're going to multiply it, and that means $494 of value is going to disappear because we sold it. Now, 130 units, subtracting 38. So I take the 130, I subtract the 38, and it tells me how many more units have I taken from this 150, right? From this 150, I need to take 92 units. Of those 92 units, they're going to cost $14.25. So if I multiply that out, it's going to tell me that those units cost $1,311. So does everybody understand how I did that? Right? Because the 130 minus the 38 is equal to 92. Those 92 have to come out of our second batch, which is the 150 units. So that we get the first in, first out. So that was my sold. What happens next? If there was another sale, I would just continue. But there's not. There's a change. And as soon as there's a change, I have to do a balance. So don't forget, I forgot to do something. My apologies, guys. These are in brackets. Because they can't be negative unless I have a negative brackets, right? So there we go. They're in brackets. So now, 38 minus 38 is equal to 0. 150 minus 92 says that there is only 58 remaining. And those 58 remaining are going to be at the $14.25. So I'm going to multiply it, and it's going to equal over here 826.50. Now keep in mind that I can actually calculate this in two ways. I'm going to change my color again. I can multiply going across, but I can also subtract going down. Those numbers are identical. Every single time they're identical. If they're not identical, then you know you did something wrong. Okay, so now we have a balance. What happens next? Well, on August 20th, I purchase. How many do I purchase? I purchase 125 units. At what value? At $15.50. And what does that equal? It equals $1,937.50. Next thing that happens, August 25th, I sold. As soon as I flip what I'm doing, I got to do a balance. So nothing here. How many are the total number of units that I have? 183. Don't need this. And what's the total value? I just add these two down, and I get 2,764 units. $64 for those 183 units. So now I can go on. I'm just going to change my color again. So now we're at August 25th. And I sold. How many did I sell? 130 units. Well, the first thing that's going to happen is my 58 is going to disappear, negative 58. At what value? $14.25. That's going to equal negative 826.50. Now, 130 minus 58 will tell me how many units I'm going to take out of the 125. From there, I'm going to take, just a minute, I got it here somewhere, 72. Now, does everybody understand how I got the 72? Any questions about that, or are we good to move on? Okay. Just let me know if you have any questions at all. So that 72, of course, is coming out of the 125, and the 125 is at 1550. Multiply equals negative 1116. All right, so what's next? Well, nothing. So what am I going to do? Well, I'm going to do a balance because I'm at the end of the period. Nothing here. 183 minus 130 means 53 units. That 53 units, well, we know the 58 is all gone, so the 53 units are coming out of the 1550 batch of inventory. We're going to multiply equals, or remember, because we could do two things here, right? We could either multiply going across, or we could determine it going down. Both values should be identical, and if they're not identical, you know you did something wrong. So the value here is $821.50. So this is equal to ending inventory. The question becomes, what is the value of cost of goods sold? Well, that's really easy to do. We simply have to take the total of all the negative numbers that are purple. The total of all those negative numbers equals cost of goods sold. So if I add up all those negative numbers, it's equal to $3,747.50. This is the cost of goods sold. And the $821.50 is equal to ending inventory. Questions? Or do you understand the method I'm using? And again, you can use the 9-chart thing, like the 9-column chart. I am totally good with that. I'm just trying to open your eyes to a potential alternative. Any questions, or can we move on to the tracking chart? Yes, I do think that this is a lot simpler to use as long as you understand the flow, right? And I find it's really important to put this here. I then use that as a basis to move forward, because you got to think, this only has two things, an opening inventory right here and a purchases, but you could have an opening inventory and 3 purchases. And so you've got to be sure that you're tracking from the oldest and taking away those ones first. All right, so let's go to our tracking chart. Here we go. We got our tracking chart right here. So remember, under FIFO, we had ending inventory of $821.50, and we had cost of goods sold of $3,747.50. If we add these two numbers together, $4,569. Now, what does that tell us? The totals are the same. So what does that tell us? It tells us that the different, it tells us that the different methods do not change the total value of the inventory, which makes sense. It's not like we're buying a different amount of inventory. We're using the exact same base information. Instead, what's happening is we are moving the inventory from being inventory to being an expense in the cost of goods sold in a different way. We're still moving the same units of inventory to cost of goods sold, but we're changing the dollar value of the inventory moved. And that's what's causing the change in the ending inventory and cost of goods sold values. If we were to calculate ending inventory for all of these, the ending inventory would be exactly the same. And let's just confirm this by looking at it. Okay? If you look here, what's the ending inventory? And if we add up all this inventory right here, oh, and change the color. If we add up all this inventory right here, we will see that this is 53 units. And if we now go, look, it's 53 units. Ending inventory is exactly the same, 53 units and 53 units, right? We're not changing the number of units that have been moved out. All that's happening is we are changing the dollar value that we apply to each individual unit. All right, are we good to move on to average? Okay, excellent. So we're going to use average. Oops. In the average method, I'm going to do the exact same thing. I'm going to do date. I'm going to do description. I'm going to do units. I'm going to do cost. And then I'm going to do value. So this is nice because under both methods, FIFO and average, we use the same headings if you're going to use this alternative method. So we got the date August 1st. Remember, this is the opening inventory. Remember, there was 38 units. They were at $13, and that's equal to $4.94. So it looks exactly the same right now. We've got August 7th. They bought more units. They purchased units, and they purchased them at 150 units at $14.25, and that equals $2,137.50. No difference. Remember that there's a change now. We're going to do a sale. And as soon as there's a change, what do we have to do? We have to do a balance. So we're not going to do this. We're going to add these two together. And so this is 188. We're going to add these together. And this is $2,631.50. So now we're going to do something different. I need to know the average cost of this inventory. In order to calculate the average cost, I've got A over here, B over here. And what am I going to do? I'm going to take B and divide it by A to find out the average cost of this inventory. So the average cost of the inventory is $13.9973. So all I did was I took the $2,631.50 and divided it by 188. Now I take it to 4 decimal places because it reduces the rounding error. All right? So that's a calculated number. So now, what happened? Well, I've got I sold. On August 13th, I sold, how many units did I sell? I sold 130. I'm going to use this weighted average exactly as it stands. Multiply it, equals, you've got negative 1819.65. Does everybody see how I did that? Okay. So now, if I had another sale, I would list it immediately, but I don't have another sale, right? Instead, I'm going to buy something, so of course, as soon as there's a change, I got to do a balance. So here we do, 188 subtract 130 is equal to 58 units. And the 58 units are going to be at 13.9973. Now, we could multiply this out, but I don't. Because of the rounding error, there's always going to be a mistake. Instead, for this method, I always just do the addition down. I take the $2,631.50 and subtract the $1,819.65, which is equal to 811.85. So remember, you can multiply it out, but you're probably going to get a slightly different answer because of a rounding error. So I don't recommend multiplication. I don't recommend multiplication. Instead, what I recommend is doing the calculation down. All right, so now, what's next? We know that there's another purchase on August 20th. So we got purchase, and that purchase is 125 units at what value? $15.50. I'm going to multiply it out, equals, that is equal to $1,937.50. So what happens now? Well, there's been a flip. Right? I've got a purchase. If I had more purchases, I would just list them, but I don't. I'm flipping over to a sale. And as soon as I have a flip, I got to do a balance. So here we go. 125 plus 58 is going to be 183 units. Don't carry anything else down. I'm going to add these numbers up. That equals $2,749.35. What am I going to do now? Well, I'm going to do a calculation. I'm going to take this A and this B, and I'm going to calculate the average. Exactly. Is it 40? Oh, I think you meant, yes. Okay, good. I'm going to do that, and I'm going to carry it to 4 decimal places just to reduce the rounding error. So this is B divided by A, just to clarify it, and that is equal to 15.0238. So now I have a new average cost. So what happens next? I have a sale, right? So here we go. We're going to do the sale, and that is at August 25th, sold 130 units. And of course, what's going to happen, I'm going to carry this down, 15.0238. Here I multiply. When I'm just doing the sold, I have to multiply it out. So here I multiply it out, and I get negative $1,953.09. And then, of course, what happens, it flips because I don't have anything else going on. I need a balance at the end of the period. So guess what? You already know this is going to be 53. And I'm going to carry this down, 15.0238. Now, I'm not going to do, remember I said, don't do the multiplication. Always do this down, because you're going to end up with a rounding error and it's going to get confusing. 796.26. So what is this equal to? Ending inventory. What is the total for cost of goods sold? Well, that's easy. Cost of goods sold is equal to the sum of all the items in a bracket. Right? The items in the bracket, 2 purple items, $1,819.65, $1,953.09. So that is equal to $3,772.74. So here we've got the cost of goods sold, and our ending inventory is right here. So again, a slightly different method than what is in the chapter. And you are welcome to use either method. There is no right way of doing this. I just do it a slightly different way because I find on the test this is a lot faster than recreating the chart. So in the 9-column chart, you have to multiply even though may cause rounding errors. In the chart, no. So what happens in the chart is you'll do a cost of goods sold, and your cost of goods sold will look exactly like this, and it'll look exactly like that. And then when you're calculating the ending, you can simply take the previous balance and subtract the cost of goods sold. You can do it exactly the same way. How many decimal points should we keep? First of all, if you're working on Wiley, make absolutely certain you are reading the red highlighted information, because they will say something like, use 4 decimal places for all your calculations, but round your final answer to the nearest dollar. They want you to use 4 decimal places while you're doing all of this. But then when you come to the final answer, they're asking you to round to maybe the nearest penny or the nearest dollar or the nearest, all right? Make sure. But I always use 4 because I find it reduces the rounding error. All right, so if everybody's clear on this alternative method, and again, don't forget I'm going to post the recording so that you can check it out. I'm going to put it on our chart, right? Our tracking chart. The average, we said the ending inventory was 796.26, and the cost of goods sold was 3772.74. When we add these two numbers together, they are 4569, which should surprise none of us, right? Because this does not change the value of ending inventory. Instead, what it does is change how we move value from the statement of financial position ending inventory to cost of goods sold on the income statement. And remember, companies cannot play with this, right? They choose a method and they use it consistently. The only time they can change the method is if they determine that a different method would provide better and more relevant information for the decisions of the users of the financial statements. And then they have to provide a very extensive explanation as to why they're changing it. And they also have to show all past years with the new method. So they have to restate all their prior years. So how do companies, but companies can use two methods for different types of inventory? Oh, absolutely. So if you're looking at a company that's carrying fresh produce as well as, a superstore that carries groceries as well as furniture and clothing, you will find that they will use FIFO for all their food, but they'll use average for all the clothing and furniture that they have. Right? So companies, different types of inventory can have different methods. But once they've chosen that method, they have to be consistent with that method moving from year to year. All right, so how do companies choose between specific identification, FIFO, and average? Don't forget, specific identification is the recommended method, but if you can't specifically identify something, so for instance, in a superstore with groceries and clothing, let's say, and furniture, you can imagine that these items are not going to use specific identification. They're going to use FIFO or average. So now, if specific identification cannot be used, then how do they choose? Generally, they use the physical flow of goods. So food would most likely be FIFO because the physical flow of goods is FIFO, right? They only put the oldest inventory out. They don't put the new stuff at the front. Whereas clothing generally uses average. If you look at clothing stores and you look at their financial statements, in the notes to the financial statements, they'll tell you that they use average because they can't control what the customer buys. Regardless of which one they choose, they have to choose a method that provides an appropriate valuation of ending inventory on the statement of financial position. IFRS believes that the statement of financial position assets, liabilities are paramount for valuation purposes. So the method used has to provide an appropriate valuation of ending inventory. And what that means, appropriate, would be that ending inventory is equal to its future economic benefits. right? Because that's the definition of an asset. All right. So we've done all this. We've done our count. We've adjusted it for ownership. We've used a method all the way through the year. We've appropriately valued our ending inventory using that method. Can we now use these numbers? So let's say we use FIFO. Let's just assume that the company has used FIFO. We've gone through this whole process, and wait a second, I'm just going to highlight this. The company's used this whole process, and they've come up with these values. And here is the value for ending inventory. Can we publish that on the financial statements? I need a yes or no. What are your thoughts here? But don't forget, we did verify. Remember, we did. So let's go through it again. We chose a method at the beginning of the year. We used the method consistently throughout. So we chose FIFO, we used it consistently. We counted our inventory at the end of the year. We checked ownership, and we adjusted the number of units and reflected that in our valuation. So we've done all of that. All those steps are finished. Can we now publish $821.50 on our financial statements? Thoughts? Why no? Or are you just saying no because you know I'm making you walk into the pit? I want to know why you said no. Thoughts, anyone? I can see some people are typing. I need some thought behind it. No, we already did the inventory count. Suzanne, remember, we did the inventory count because even though we have verified, we don't know if there is an ownership. No, we already did the ownership too. We've done all of that. We've done the FIFO throughout the year. Inventory could be old, but when we counted it, we would check for old inventory. Chelsea's got it. The lower cost, exactly. Lower of cost or net realizable value. So here's the biggest thing that's happened, and I think that this issue has become more and more prevalent as time goes on. So we have become a disposable society, right? I don't mean disposable society. We've become a society of disposable things. And as a consequence, the lower of cost and net realizable value has become critically important because the lifespan of products has shortened over time. So for instance, the lifespan of a cell phone is now less than a year. A new version of a cell phone comes out every single year, and actually it's every single 9 months. If you think of some products that 2 years ago we were selling and today we don't sell at all because it was the flavor of the month or this, you know, it was just something that went crazy for a short period of time and then it disappears. And fashion is a brutal example of that, right? We don't wear what was fashionable last year. Nobody does. And they try to sell it off. And so the lower of cost and net realizable value reflects the fact that items are no longer relevant. And so if we try to sell them, could we actually sell them for what they cost us? So don't forget, under FIFO, and I'm just going to go back to the FIFO page for a second. Oops, I passed it by. Under FIFO, these 53 units cost $15.50 each, right? So let's just look at that. So here we go. Under FIFO. So let's use FIFO. Assume we chose to use FIFO, right? And so we have 53 units. They're at $15.50, and that equals $821.50. So if you were looking at our T account in inventory, we would have $821.50. $50. And don't forget, we would also have a cost of goods sold, and that cost of goods sold, if I remember correctly, wait a second, I have to look back at my actual chart, that cost of goods sold was $3,747.50. Okay, that's what's sitting in there right now. But the question is, can we sell it for $15.50? Has there been some kind of obsolescence that has caused the value of this item to go below its cost? Because if it goes below its cost, we cannot reflect it at $15.50 because that's not equal to its future economic benefit. Inventory is an asset. Assets must be equal to their future economic benefit. If they're not equal to their future economic benefit, we have to write them down. So let's say that there was a significant change in technology, and a new product has now become available that's being sold for $12. We cannot sell, never again can we sell our units. Don't forget, we sold our last unit at $30. But you now have to immediately match your competitor's selling price of $12 because no one will buy your product at $30 when someone else is selling a better product at $12. In fact, maybe you can't even sell it at $12. Maybe you have to sell it at $10. So let's assume you have to sell it at $12. You can't keep your inventory at $821.50 because of the lower of cost or net realizable value. So don't forget, $12 is equal to your net realizable value. This is equal to your cost. The rule is the lower of cost and net realizable value, the lower of the two. Well, if we have to choose the lower of the two so that we don't overstate our inventory, we're going to have to choose this $12. So now it's going to be 53 units times 12, which is equal to, did I write that down? I did not. This is equal to, anybody know what it is? I don't have my calculator here. Thank you very much. 636. So we want to know how much are we going to have to write it down by, because this is sitting right here at 821.50 right now, and we need it at 636. So if I take the 1550, subtract the 12, and then multiply that times 53, it'll tell me the amount of the write-down. And the amount of the write-down, because I have the write-down amount, is $185.50. We have to write down our inventory. So this is determined only at the end of the period for financial statements. Absolutely. We only do this once a year. And the reason we have to do it, and sometimes you don't have to do it, you got to think that if you're working in a grocery store, it's unlikely, not impossible though, but it's unlikely that you're going to have to use the lower of cost and net realizable value. Although I have seen stuff in the grocery store where they're just trying to get rid of it because they can't sell it anymore. So a good example would have been after, has Valentine's Day happened? 14th? Yes. After Valentine's Day, everything goes on sale, and in some stores they were selling them for 70% off, which potentially is below their cost. But that's just short term. It's unlikely to exist at the end of the period. This will definitely apply to Christmas products. So if your year end is December 31st and you still have a lot of Christmas inventory, you're going to have to use the lower of cost and net realizable value because you're not going to be able to sell it for your selling price, and potentially you're not going to be able to sell it for your cost. All right, so we have to do an actual entry to write this down. If net realizable value isn't given to us on the test, how do we cut? You can't. You can't. It has to be given to you. Because what happens in real life is the company looks at the market and says, can we continue to sell this product for more than it cost us? Let's say that the net realizable value was $16. Would we have to do a write-down? We would not. We only have to do a write-down if the net realizable value is lower, and every company has to go out and look at the market to see if this is the case. And as I said, it becomes more and more prevalent that the faster products turn over, right? That the rate of development of new products is shortening every single year. And because of that, this becomes more of an issue. So let's do the write down, because we have to have, you got to think, we have to have we have to have 185.50 go here. There has to be a credit to inventory. So let's look at the entry. We're going to do a credit to inventory for the 185.50. The question becomes, what do we debit? Guesses, anyone? No. IFRS does not allow us to use COGS anymore. And here's the reason why. As this became a more prevalent issue, companies were hiding their write-downs in COGS. So the only time you can use COGS is if the write-down is immaterial, a tiny amount. And tiny is a relative term, right? I mean, what's tiny when the company is $10 million? But it's got to be immaterial for us to use COGS. Instead, we have to use an account called loss on inventory. This is an income statement. It's an expense account, right? It's an income statement expense account. And it's part of the operating costs. And it's not placed in COGS. I understand that the textbook has COGS. I do know that. But the problem with that is IFRS actually doesn't allow that. And they've disallowed it for quite some time. So I don't know why they keep doing it. I think they probably do it because they don't want to confuse students, but I'd rather you know exactly what it's supposed to be. If the amount is immaterial, you can use COGS. And again, the definition of immaterial is relative to the company's size. But otherwise, IFRS does require you to use a loss on inventory account so that you cannot bury it. Some companies, you know, just to give you an idea, when Danier Leather, which some of you might not know what it is, but it was a very large retail chain selling leather products. When Danier Leather had a write-down because they discovered their inventory was not selling, they did a $17 million write-down. You know, this is not a small amount. That was a huge amount. And if they had hidden it in COGS, it's true that their gross profit would have gone down, but nobody would have known that they had done a $17 million write-down. So IFRS doesn't allow us to hide write-downs due to the lower of cost and net realizable value in COGS unless the amount is small. I mean, when you look at BlackBerry, one of BlackBerry's write-downs was $49 million. I mean, that's an insane amount of money. But they discovered they couldn't sell their playbooks, so they wrote it down by $49 million. So you can see why IFRS has said, no, we're not hiding that in COGS. So keep in mind, after this entry, your inventory value would be sitting at 636, and that's what you would publish on your financial statements. All right, any questions about the lower of cost and net realizable value, why we have to do it at the end of the period, what happens if the net realizable value is lower than your cost, what happens if your net realizable value is higher than your cost. That's what we've covered up till now in this section. Everybody good to go, and we can move on? Okay, good. So we're going to do one final thing. What happens if we make a mistake, let's say during an inventory count? If that happens, what do we do about it? And the answer is we have to fix the error. We have to fix the error because it's providing information that is not free of error. So we're going back to faithful representation, also called representational faithfulness, which, remember, it has three parts to it. This is from Chapter 2, Conceptual Framework. So representational faithfulness must be complete, free of error, and neutral. In this case, it's not free of error, and that means people, users, external users, are going to make decisions based on numbers which are incorrect. are not free of error. So if there is a mistake, we must fix it immediately. So how do we fix it becomes the question. And we are going to do Q6-3 to show you how to deal with inventory errors. Now I'm going to show you my method. The textbook has a different method. Inventory errors are generally count errors. The impact has to be determined in order to correct it. So here's one method of analyzing the errors so that you can correct them. So just 1 minute, I got to flip to my question, which I've misplaced. Here we go. Okay. So I do a chart. 2014. This is the oldest year, 2015. In inventory, when you're looking at it, we start with an opening inventory. We add in our purchases. That is equal to what I called available for sale. Remember, I've already described that. Opening inventory plus all purchases equals what's available throughout the year. If we subtract our ending inventory from that, it would equal our cost of goods sold. Now, cost of goods sold goes onto the income statement, and from that, we use that to calculate profit, and profit moves from the income statement to the statement of financial position through retained earnings. So we can see the flow of information on the statements. If you have any questions about that, let me know. All right. So we've got a wrong answer and a right answer. We might have done something wrong here, and then we're going to do it right over here. So what we have to do is we have to look at what's wrong and then correct it. So what I always do is I fill in all the information that I have. So for 2014, I have cost of goods sold, which is equal to $184,500. And ending inventory is equal to $42,000. Now, 2014's ending inventory becomes 2015's opening inventory. I also have 2015's cost of goods sold, and I have 2015's ending inventory. Okay, so this is the information that's available to me. If I look over here, I'm just going to change the color for a second. If I look over here, I can work backwards and calculate available for sale. Everybody agree? What is available for sale? 226. Does everybody agree that that's the right number? I don't have my calculator. 142,500. Oh, Joanna, you're subtracting, but available for sale minus ending inventory is equal to cost of goods sold. So cost of goods sold plus ending inventory is equal to available for sale. You have to add them. Okay, so we've got 226,500. Now, does everybody agree that 226,500 must be right? Do you think 226,500 is right? So Chelsea, why do you think that it's wrong? Okay, I agree. So that means that the split between these two amounts is wrong, but it doesn't mean that the available for sale is wrong. Do you see what I'm saying? Right? Okay. Did they tell us that opening inventory was wrong? Nope. So opening inventory must have been right. Did they say that there was an error in the purchases? Nope, so purchases must have been right. That means available for sale was correct. What happened is when they did the inventory count, they counted wrong, so their ending inventory was wrong, which then caused their cost of goods sold to be wrong. But the available for sale is correct. Okay, everybody agrees with that. So that means if this is right, I can move it over to the right column. Agreed? Because I want to know what's right, and I can then move it over to the right column. Okay, so can I fix ending inventory? Can I fix the amount of ending inventory? Exactly. I just have to add in 5,000, and that will fix my ending inventory. My ending inventory is actually 47,000. Since I have a correct available for sale and now a correct ending inventory, can I calculate the correct cost of goods sold? Absolutely. The cost of goods sold is 0, 0, 5 minus 0 equals 5, 6 minus 7, no, 16 minus 7 is equal to 9. Then 11 minus 4. My goodness, you guys have a calculator. What is this? I think this is 1. I think this is 179,500. Oh, thank you. All right. So now that we have this, well, we can calculate the error. Cost of goods sold, is it over or understated? $5,000, over or understated? Too high or too low? Overstated. If cost of goods sold is $5,000 too high, what does that mean about profit? $5,000 understated. Exactly. No, no, no. What do you mean? Suzanne? If cost of goods sold, which is an expense, is $5,000 too high, then the profit will be too low by $5,000. I just want to make sure that everybody understands this before we move on. It should go. Oh, it has to go up. Yes, yes, profit has to go up by $5,000 because it's too low. But I'm asking what the error is. So right now we agree that the error is understated. So profit is understated. It has to go up $5,000, but right now where it stands with the wrong information, it is too low by $5,000. Okay, so now retained earnings, is it over or understated? If we don't make any changes, is it over or understated? It's under. Retained earnings always follows profit. It's understated. All right, so now that we have correct information, can we not take that correct information and fill in some blanks over here? The right number is 47,000. Okay, so that's all we have. So let's work backwards here and calculate the available for sale. So I'm going to leave it to you guys. No, it's 2,268. Agreed? Is that 268? Yes, it's 268. All right. Is 268 correct or incorrect? Lauren, why is it wrong? Yes, Mark, exactly. Because, not because ending inventory, no, no, no. Lauren, it's not because of that. Because remember when we were working on 2014 and we worked backwards and we said this number was right. Okay? So it's not the misstatement of this number or this number that has caused this number to be wrong. This number is wrong because opening inventory is wrong. Okay, so I'm hoping I'm making that clear, right? If opening inventory was correct and purchases were correct, then the available for sale would be correct. It's only wrong because the opening inventory is wrong. Now, can we work backwards and calculate the purchases? And if so, what is purchases? So purchases are 268. No, they can't be 268. 226. Right, 226. Now, are these purchases correct? Yes, they are, because there is no indication in the question that there were any errors in purchases. So purchases are correct. We know that this is wrong, we know that that is wrong, we know that this is wrong, and we know that that is wrong, but we know that this is right. And if this is right, we can move it over here, which will allow us to then calculate the correct available for sale for 2015, which is 0, 0, 0, 7 and 6, 12, 13, 4, 5, 6, 7, 273. Thank you very much. 273. Okay, can we connect, sorry, blah, blah, blah. Can we correct the ending inventory? Subtract 8,000. We don't want to do anything with the 50,000 or the 5,000. Lauren, I believe you meant 5,000. No, we don't know. That 5,000 may be gone. We have to correct the ending inventory, and we can only do that by subtracting the $8,000 error from the count. Is everybody clear on that? Oh, I see what you're saying. I see what you're saying. Okay, got it. So this is equal to 50,000. Okay, good. So now we can calculate the correct cost of goods sold, which is 223. Okay, excellent. So now with this information, what is the error in cost of goods sold? And is it over or understated? No, I think it's $13,000. Thank you, Mark. So and Andrew, it's not over. Don't forget, this is what we've recorded so far. So it's sitting at 210,000 and it should be 223,000. So it's understated by 13,000. So I agree, it's 13,000, but it's understated. I'm sorry, I'm losing my voice. Just one second. Sorry about that. I'm trying to cough it away. All right, 13,000 understated. So now, what about profit? Okay, so profit is overstated. And retained earnings is overstated also by $13,000? No, it's only overstated by $8,000. Does everybody understand why? It's only $8,000? Yes, but do you understand the sense behind it? Yes, because you got to think retained earnings is carried forward. So last year, retained earnings was too low by $5,000, and now it's too high by $13,000. So in the end, it is overstated by only $8,000. Right? Because retained earnings is carried forward, so all the errors are carried forward also. All right, what is the last question in the webinar? Explain why it's important for green ink to correct these errors as soon as they are discovered. I already explained that. I jumped the gun. I apologize. All right, this is the end of Chapter 6. Does anyone have any questions at all? I hope this really clarified your thinking about Chapter 6, in particular, the calculations. Thank you, everyone, for coming. And you guys have a great evening, too. Take care of yourselves. You guys are very, very welcome.